there's framework that we're going to pull in with the daily chart today, okay, because it's salient to the discussion. But I want you to know that we did not refer to anything above a 15-minute chart, except for the session on Monday where I showed you that big gap on the daily chart, which happened to be the new week opening gap. We'll talk about that today, and then how also that fits into the equation of how we're using the clustering of inefficiencies with new day opening gaps and new week opening gaps, because I know there's a plethora of questions that this week has caused you to build up in your mind, or maybe you have a journal page full of all kinds of questions. I hope ICT talks about this. I might hit some of them today, I may not. Okay, but just know that every time you show up here, I'm going to answer something. And it may be a question that it's been months or longer for some of you. And then I'll say something that will open your understanding about it and say, oh yeah, now it makes perfect sense. And it may not even be me directly saying the very thing that you have a question about, but because you get further understanding about another element that supports the underlying question or concern or doubt you have, then it becomes, oh, well, okay, now it makes sense. And there's so many opportunities for me to be able to draw an analogy from. I can't begin to start with one of them. But the session starting at 6 o'clock, okay? We're going to zoom in this little area right here. All right. Here is the 5 o'clock, or in this case, 4:59 candle that closes, and the final print on that candle comes in at 18,558 even. The very next candle at 6 o'clock, because of our delay where markets are not trading, we open up, and that's the opening price down here. Okay, so that opening price, which you can see at the top of the chart, is 18,550.25. So between the difference of where we closed at the 5 o'clock hour and where we opened at 6 o'clock, that is what? That's your new day opening gap. And since we opened lower than where we closed, that means we have a discount, lower opening. Is the difference between this close and this open greater than 20 handles? No. It's literally less than 10. So am I going to draw a line in there? You can. If you want to have them on your chart, there's nothing wrong with that, Caleb. But if you are going to follow the rules that I'm teaching on, you really shouldn't need to see that line. Your eyeball should say, okay, well, right about in here, that's about the middle or consequent encroachment. And then if you can eyeball that, then you can eyeball half of that is the upper quadrant and the lower quadrant. And it's just a matter of doing it. Okay, you don't have to have every single line on your chart, because otherwise it's going to be a lot. And you don't need a lot. You just need one or two elements to have in mind where you think the price is going to gravitate to or gyrate around. And based on, like, for instance, we have the economic calendar today. If you've already done your homework and noticed that today there is no medium or high impact news events, none. It's Friday also. We've had a large weekly range. I'm going to talk about that for TGIF purposes before we close as well. So when we have this in here, we're waiting for the market to do what? We're waiting for the market to create motion around this new day opening gap. Do not trade initially. As soon as you get the gap noted here, you're not in there trying to trade off of it. Why? Because there's an element to time that has to be referred to first. Because as I mentioned in ad nauseum, the markets will not move until it's time for them to move, which is algorithmic. Yes, price will gyrate. They may have meaningless, aimless little movements, okay, that I'm not interested in. But when time is now introduced as the factor that's the greatest importance, that means at 7 o'clock to 9 o'clock, that's your Asian session. You can use this new day opening gap now and build it around the element of liquidity. So what does that mean? Well, if you look at how we have the market work and gyrate around. I'm going to maximize just this chart. I know you're over here looking at this stuff like it's some kind of secret weapon. We're gonna have all these lines amplified on the chart. I'll show them all to you, and it's most of everything that you've seen all week long. Nothing's been added except the new day opening gap that was formed for Friday's trading last night at 6 p.m. Eastern time. There's nothing else over here, so stop looking over here or here. Well, it's the same lines you've been watching all week. But I'm going to maximize this chart here, and I want you to see what we have done. We created a high, and then we had created another high. So what is this high here in relationship to this one? What is that, Caleb?
Relative equal.
You're gonna speak up. Relative equal high. Okay. So we annotate that. So above this high, there's liquidity, and it's the form of buy side. You want to be annotating that, so that you're going to be taking screenshots of these types of things. After it's happened, you start like this. You don't try to predict them. You're trying to avoid, I need to put this to work right now and see if it works right now. No, you're studying it after it happens. And then you do a walk forward where you're watching price without any button pushing, without any kind of hard opinion. But you're doing it with the expectation of collecting experience watching it. So you're going to be doing it on the top and the left, and that's how I like to annotate mine. Okay, so now we have the market that opened at 6 o'clock. We traded above, short-term high. You can annotate that as a minor buy-side liquidity pool. It drops down, takes out this low. You can annotate that as a minor sell-side liquidity pool. But what you're waiting for is you want to see price do two things. You want to see it leave the new day opening gap. You want to see it cross over it and go below it. When it goes below it, you don't want to see it just trade below it for the sake of going below the lowest low of it. You want to see a short-term low taken. It does that. See that? So what has it done? It set an initial range to build and engineer liquidity. You don't even need to see this one yet, but what we're doing is we're seeing how price, and I'll annotate it here for you. That high, and let's change it to black because I want it to be different. And we'll do this. That's not what I want to do. If you hold down Control and click on the line or thing that you want to copy, don't do it on the little button here. You got to do it somewhere over here, and then drag your mouse away from it. It'll copy it for you. I learned that from my students, by the way. Most of everything I learned on TradingView is all from students. So this is a little minor. That's a minor short term. So it would look like this: minor short term buy side. And you make that real little. And again, on the top left. Okay. And the same thing with this down here. You're going to hold down Control, drag from the middle of the line. It'll copy it. And you put that right there. And drag it through a little bit. And now you want to make sure that that's underneath it. So it's below. So bottom left. And you want to change it to sell side, because that's what's below old lows. Sell side below it, buy side above it. Okay. So what that does is it helps annotate your chart. And when you refer back to it, what I'm doing there is I'm holding down Shift. That way I'm keeping the line straight. And it keeps everything nice and neat. You might want to make that font and text size larger, but for me, I like that because I don't want so much attention drawn on it. I just want you to know that these are the types of things I want to see in your chart around the openings, okay, or the times I'm teaching you to focus on, like the 7 o'clock in the morning, the 8 o'clock in the morning, the 9 o'clock in the morning session. Since that's your time, you're going to be looking for the same event there, okay? So this is amplifying what's already been taught in this week's live stream, but I'm applying it to this time of day for the folks that can only trade this time of day. They may not be able to do what you're going to be doing or trade at all except for this time. So this is Asian session trading. This stuff works for Forex too, so don't think that it's just a one-trick pony for indices. This is exactly what you'll be doing the same thing in Forex. Okay. I don't trade crypto. I don't know. I've never investigated because I don't care to trade crypto, and I'll never do it. So I know a lot of people are still asking about that. But we have a short-term sell-side liquidity pool below here, and we have a short-term buy-side liquidity pool here at 6 o'clock, and then we have the new day opening gap. So we have new day opening gap, and what we're watching at that very moment is you want to see it trade away from it, which it does. Is it going somewhere randomly? No, it's just going in here to do what? It sets an initial range for building and engineering liquidity. That means now there are going to be buy stops that form right above this high. So this is what you're going to have in your chart. And on the bottom, down here, and some of you are like, man, this is a lot of stuff to be doing, and I ain't making money yet. Well, if you don't want to do this, go trade indicators and check back with me in 6 months and tell me how you're doing. I know you'll be watching these videos. And I'm going to stretch this out just a little bit more because conflicting. So now we have that on the wrong line, sorry. That's where it needs to be, right here. So what we've done is we've taken out this short-term low, and we created an initial sell-side liquidity pool, and we went above this short-term high, and we created an initial buy-side liquidity pool. Okay, why is that classified like that? Why am I labeling that high, and why am I labeling this low? And why is it initial buy side and initial sell side? Because we've opened a new day at 6 o'clock. We created the inefficiency that is the new day opening gap. It's moved away. That's the first thing we're looking for. It needs to move away from it. It does so. What is it going to do? It takes out the short-term buy side. Does it go back down below the new day opening gap? Yes. Why? Because the algorithm is calibrating and setting, and this is visually representing how the algorithm engineers liquidity. It takes a short-term pool of liquidity out and then goes to the opposing side below this low. Now there's a new low and a new high after 6 o'clock. You see that? This is the initial high and the low that every trader that trades at that moment is going to refer to for where their stop loss is going to be. So this is no longer a factor. So while that's important to have on your chart for the purposes of learning, you want to kind of like keep it muted. Don't have it so prominent in the chart. And the same thing down here. But you do want to have it initially as a screenshot while it's doing this. When it runs up here like this, when it does that, screenshot it. And then later on, if it rolls down and take out that low, screenshot it again. Because you want to see these screenshots as they go to the levels of interest. Like this, it should do that. Now, what happens if it did this? If it was in here and it went down there first and it took out that low? Okay, you would screenshot it as it happens, and then you would anticipate it running above this high, in which you would do, classically, it will do that. There are times when we start the new day at 6 o'clock, and it'll just dilly-dally around and do nothing. And it won't even bump above or below. If it doesn't do that, don't worry about it. That's typically telling you that Asia is going to be dull. It's not going to do anything. It's probably a good day for you to just go watch a movie with your spouse or go exercise and then go to bed early and get rested for your workday tomorrow. But you want to be doing things with a purpose of knowing that it's going to fit the characteristics that are synonymous with the market making a sizable move that's predictable. And if it's just real lethargic and lackluster at 6 o'clock and it doesn't really do anything going into 7 o'clock, because that's your key time, 7 o'clock starts the Asian session. And you think it's just Forex. No. these markets are ran through artificial intelligence. And sometimes they're tweaked a little bit manually to cause a little bit more excitement or to disrupt something. Okay, so now we have initial sell side liquidity for the day and initial buy side liquidity for the day. Outside of those two reference points, then you look to the left and say, okay, where are the larger pool of liquidity? Well, obviously it's here. So if we have that, once we broke through here, we have to see it do another characteristic with the new day opening gap. We have to move away from it initially, go to a short-term high to take liquidity out, which it does here, and then drops down below, crossing over the new day opening gap. So this is where you want to see it coloring outside the lines. Okay, so many times I've introduced ideas and talk about specific PD arrays, and when I tell people annotate this level, annotate that level, this is a fair value gap, this is an inversion fair value gap, this is something else. And as soon as someone that's watching it sees it cross through, they think, aha, it didn't even hold. He thought, you have no idea what the fuck you're talking about. You have no idea what you're talking about. And this is the stuff that pisses me off, because they can't wait to do the, I gotcha, I'm going to go on social media, see what ICT did here, did it wrong, and then try to make videos and bullshit. This is the logic behind it, okay? You want to see it trade away from the new day opening gap as it formed. And if it goes up, it's taking a short-term high out. And then you want to see it cross back over it and seek a short-term low, which is what it's doing here. Once it does that and it crosses back into it again, we have now set initial buy-side liquidity and initial sell-side liquidity. Now you're going to wait. What are you waiting for, ICT? When's the time of day for Asia? 7 o'clock. Okay. Go over here to the vertical line. Does this seem complicated yet? Let me know. Let me know if this is complicated, okay? Because this is really simple stuff. Really, really simple stuff. So now we have what happened. The market crosses back above new day opening gap. Does it take out the low here, right there? As we're heading into 7 o'clock, what is it doing? Is it moving to this low to challenge this sell side liquidity?
Absolutely not.
So what is it doing here energetically here? What is it doing?
And it's placed in the upside.
Right. So it's crossing over the new day opening gap. And then at 7 o'clock, what does it do on the 7 o'clock candle? Look close. Let me take this away for a second. What do you see it do?
And it dips back into it just slightly.
It retrades to the new day opening gap that was formed right over here. You see it touching that?
Sure.
So if it's going to go back to that after having displacement here, it's already set the initial boundaries for the sell stops and the buy stops. So the algorithm is giving the signal right here. Now we're inside the element of time. Dave. So the market should displace above this high, relative equal highs, challenge the initial buy side liquidity, and will test and hold to see if it can run above this high. Now, because you sat with me last night, we actually did this. We actually traded it. We pushed the button, and there it is. But I'm going to show you the logic behind it, so that way you, as a individual that wants to trade the Asian session, this is the protocol, this is the guidance, this is the step-by-step, this is what you do, this is all you do. Every single day, you're looking for these signatures, these characteristics. If they don't do these things, guess what you don't do? You don't push a button. You don't trade it. You don't have high expectations, but you still study it. Is that clear?
Yes, sir.
Okay. Not that you're going to be trading this time of day, but I have to make sure that it's the same way for you when you're doing it in the New York session. So at 7 o'clock, you're going to be studying and looking at price to do these same things. So if we look at how the price opens on this candle, it drops back down and touches and retrades to the high of that new day opening gap. So everything's in motion. Everything is set. We did not have an interest in going back below the initial sell side liquidity that took out this low. The key things are this. We're gyrating around the new day opening gap. You want to see this. But when it comes to time, 7 o'clock is your time in Asia. The algorithm will come online and you'll see buy programs and sell programs begin right at 7 o'clock or just after it. Okay, and you're only really interested in until 9 o'clock. So if you're a working class hero in the United States, or if you're overseas and you want to trade in this time of day, your key times are 7 p.m. New York local time to 9 p.m. New York local time. So it's a small little window of focus. You don't have a whole long, it's not 4 hours. It's a very small segment of time. And I want you to go through your charts, and I want you to annotate these things, not you, Caleb, but everyone else that may have an interest in this. Even if you don't want to trade this type of or time of day, it's beneficial for you to log this, because you're going to see things that will further prove that the markets are algorithmic, and they're operating on the things I'm teaching you that they do. Okay, so anyway, the down close candle in here, it trades down, touches the top of the new day opening gap, and now because it's 7 o'clock, it's proven that it's not going to go down here. It has no interest in it. And this run here, this right here, that is indicative of that it wants a run. So because it's doing this buy side imbalance, sell side efficiency, I would have no interest, as you saw last night. I'm not interested in seeing it come back down into that gap. So what does that make this gap? It makes it a breakaway gap. And so if it's going to break away from running higher and not going lower, what's it going to seek? This short-term high. I want to see, does it have momentum and speed in which it takes that relative equal high out? This high and this high. When it trades there, which it does right there, it pops through it real quick and then comes back half of this range, consolidates around it, boom, runs into initial buy-side liquidity. So now I want to see this, treat it as rocket fuel. You ever see those guys that have their funny cars and they have nitrous oxide? You want to see the nitrous oxide button pressed in price action right when it does that. You don't want to see it go up and then go right back in, because what that was is it's a fade. That's your turtle suit. It's a fake out. What we're looking for is, we want to see like a nitrous oxide injection of strength, speed. When Dad does the recordings when I'm trading, and I'll type out and say, I want to see speed and magnitude. I want to see distance. That's because I'm expecting these elements in price action. At that moment, I want to see that being visible in price. And you can see it happening here. And then we gap up. Where this candle closed, it gapped up here. When we trade back down into that, right there, that is an entry as well. And you'll see those things as we start going to the charts live. I'll point them out to you. And when we take screenshots, this is an actual wonderful buy. And then we start to roll up here. Then we see the classic volume imbalance, retrade to it there. And that's another buy. And then you have this big pop here, which we watched happen. I mean, we both were like, yeah, when it happened, I was like, yes. Well, it runs up there and took the buy side here. So visually, you can see how in this candle, I'll put that right over top of it, you can see the entry right there. And what I was aiming for, as I wanted to watch when it opened and traded down, I wanted to see it get below the body of that down close candle. I don't care where in the spectrum of that wick, because that's a discount wick. I'm buying that order block because I understand it's an order block. Everybody else will simply say, well, you got to look to buy the down close candles. And that just shows that they only listen to my very first introduction to an order block, because they don't understand what an order block is. So I want to be in the discount element of that down close candle, and I want to be entering below its body. In this case, it's the close. So if you look up here in the upper left-hand corner, you see the close. It says 18,560.00.
Yes, sir.
I want to be buying below that, at it or below it. And my entry was 559.75. So that's pretty good. And then it rallies. And when you have this break like this, your stop loss has to be below the consequent encroachment of the new day opening gap, which is what you watched me do last night. So for the folks who are saying, well, where would your stop loss be? Because we gapped up like this, and we've already done this. Watch what we've done. We've opened here. We created a new day opening gap. We took short-term liquidity here. took short-term liquidity here, and then we crossed back over top of the new day opening gap, and then crossed back down below it, and then we have this displacement ahead of 7 o'clock. You see that, folks? You see how that element of just it's letting everybody know that C's price with this understanding. You're not supposed to know this. I'm not supposed to be teaching it really, but these are the like the little hallmark signatures that okay, it's about to happen. So now we have to reference these completely random levels, the new day opening gap, something that's been renamed and revamped by somebody else that nobody has an identification on. Nobody's there to pick the $5 million up for me having been exposed as this is where he copied it from. Wyckoff has no idea what the fuck we're talking about here. If he was, he'd be my student. This touch of that high of the new day opening gap, that's your trigger. But I want to get in there right as it's trading back to that wick, which we're going to talk about wicks as gaps today also. The market has immediate feedback and tells me I'm on side. I don't need to worry about anything now. And as soon as we take out this high here, the stop goes to break even, or at the very minimum, it has to be at the top of the new day opening gap. And you don't chase it. You can see me rush my stop loss. I mean, you just relax and let it happen. So the market gives us two qualifying, comfortable, like consoling, like it's okay. Don't worry about it. It's coming because we see the displacement here. And when we see the displacement, every displacement does not have to see it trade back down into. It's better for your trades to not see them return into buy side and balance, sell side efficiency at all. That's what you really, really want to see. Okay. If it has the interest to go back into it, that is indicating that if the move's coming, it's being deferred, and you're gonna have to sit through a period of uncomfortable waiting and maybe a little bit of drawdown or chopping it around before it takes off. I don't like those types of trades, which is why I like to look at the market when it creates these types of characteristics, where it's really indicating that hey, it's about to pop, and it's doing exactly what I want it to do. We can time it because the market operates on time, not price first. It's time first, and you have to know what these elements of time are and why they're a factor. Otherwise, every Mickey Mouse bullshit indicator or even my stuff applied at the wrong times isn't going to work. So you have to have these elements of time determined ahead of time, and it has to be your central focal point for your model. And if you can't arrive at that as okay, that makes a lot of sense, then you're going to struggle. You're not going to have any success with this. You're going to think it's all contrived. As much as I keep showing it and proving it, it'll still just be he's lucky, or it's just it just happened to be randomly in his favor that day. And it's anybody can make excuses for not wanting to do it, but no one can make an excuse and say it's random, because it's absolutely following the logic that I've been teaching for decades. So there's our entry, and then we want to aim for something above this buy side liquidity pool. Because if we know that it's likely to trade up above it, how can we arrive at a target that is close to it? Well, what was the leg of price prior to this run up that's going the other direction? Can you see it's this high down to that low? So in other words, we had this movement kind of like a slingshot or a catapult. Price is winding back, and then it takes off and runs for it. You see that?
Sure.
So we can take this price leg here to that low, and we can get some measurements to get a baseline for range finding. So if I'm interested in a run that goes above this high here, okay? Once we have indications that we have this high taken out, which is what we get there, that's the second qualifier that really builds the confidence that this trade is going to be a runner. In other words, you should have no anxiety at all about the trade not panning out, because we had this ahead of time, right, going into 7 o'clock. We already worked above and below the new day opening gap. We kept initial sell side in play there. And now we refer back to this one. So this is the buy side. So that's where your initial interest is. Do we have the momentum and interest to power through that? Because it could have very easily done this. It could have went above it and then started to break down. And that would have been just simply a losing trade. And there's nothing to be afraid of with that. But it's not likely to do that if you have something like this where it starts running energetically, proving that that low is now not interested to take out that low. And now the buy side here and here and here is where we're focusing on. because the Johnny come latelys that didn't trade yesterday and they weren't bullish, they're trying to get in board. They're trying to get on board because now the market started trading at 6 o'clock and they're trying to buy anything that gives them a reason to be long. So I want to capitalize on that and know that any rallies that it forms is going to be short lived. So I have to know beforehand, where are my exit points? So how far can it run up above this buy side liquidity? Well, we're range finding by taking the fib from here to here, and all we're doing is measuring the distance between that low and that high, and then duplicating it. Okay, going up one measurement of that and then a half, which is why we have that standard deviation there of one. It's negative 1.5. So what that is this range from high to low times 1.5. So you get a baseline. In other words, let me show it to you like this. If I do this and show you just -1, what that will be is a perfect measured move. So in other words, it's from the low to this high. Perfect duplication added to this high would be here. Okay, so that would be a good place, to take a partial. If we had more than one contract on, we could have took a partial there and had a limit order to sell there and then aim up here. But because of this idea of this is where it can color beyond my expectation of just going above that high, then this is one standard deviation. So what I do is I like to find the midpoint between that. So if I do something like this, I'm just going to eyeball it real close. Okay. If I know that this is where the midpoint of both targets are, so if this is one standard deviation, and then we have negative 1.5, it's affording me the ability to see where targets could fall. And I don't have to be perfect about getting the actual high, even though it does trade up there. And when you first saw the Fibonacci laid on top of it, it looks like, wow, it went right to it. But you can see my price exit was 607.5, which is just above, halfway. So we have -1, which is a full measurement of this high to that low, and let me show you graphically also. So it's this range here. You take that and you add it to the high, right there, and you see that's what that is. So you can see I'm taking that little block of price action from this high down there, and I'm thinking of that as a block of price action that if it's going to go higher, and it has typically always. It's very easy to have a very low threshold targeting methodology based around measured moves. And this is the classic measured move perspective. But I don't like that because everybody, Tom, Dick, and Harry, is thinking that way. Mm-hmm. And I know that while that's meeting the criteria of getting above this high for the sake of trading into those buy stops, I want to have the next tier in precision. So I want to know where is it really likely to trade to. So if I get a negative 1.5, I'm getting this range, but I'm also aiming for kind of like extrapolation, where it just gets really ahead of itself and just gets animated way beyond everybody else. I mean, like we said last night, we were watching it, like, whoa, that thing really took off. For Asia, it was really fun. It usually isn't that eventful, but when it popped up there like that, what I had done was I looked at the -1 and -1.5, and in between that, okay, that was kind of like what I was aiming for, which is like 1.05 something. And I was thinking, okay, well, I know it's very likely to trade up here, but what happens if I don't get my limit? You've watched me before where I'm putting trades on and they give me the price that should fill me and it don't fill me. So because I'm trying to be too precise. So the way I trade, I want to be in that little gray area, which would be here, between where I think it ultimately may reach for and where a certain measured move idea, where that's real. Measured moves, if you're going to say, Dad, give me a roll of pulling out targets where I know that they're absolutely low-hanging fruit and I don't have to worry about it, and you're willing to let bigger runs just evade you because you want to be able to get into the trades, and as long as all things being equal are saying that trade's viable, where is the no-brainer exit? That this is always most likely going to be the best exit point that I can take and not worry about it, not do too many calculations and spend too much time. It's the measured moves. So whatever price runs that you're expected to see, if you're looking for a bullish run, just look at a price leg that was prior to the run you're in as a long, and then do a measurement like I'm showing you here, and that would be here. If it meets the criteria of trading into an old high or relative equal highs, because there's real stops, that's going to be the draw. The market's going to want to book there because there's real orders resting above that. Well, that is who I am. I'm always trying to be better than everything else. So I want to know where it's going to reach for, but also the human in me that can tend to be wrong sometimes. Or sometimes the market's just fickle and says, fuck you, ICT, you're not getting your limit order, right? So I want to be in that gray area, which is between where I think it ultimately is going to go and the low hanging fruit threshold, which is in this area here. So that line right there, I want to have an exit that's above, at or above that level. See that?
Yes, sir.
So this is the reason why we talked about this. I'm just doing it for the sake of the people that are watching and wanting to learn. But if you look at where I exited, you see where see that little arrow that appears when I hover over top the arrow that shows when I got out at? That's where my limit order was. And I'm okay. Truth be told, I'm really not okay. I'm really not okay. I really want to be able to nail the highs and do all that. But I also know that sometimes they're just going to say, screw you. Okay, you're not going to have it today. And I don't like when they have that win over me. So I'm just going to be content with this is good. It's better than most people on the internet. It's better than most people that trade. They don't have a methodology that's going to be consistent that drives them to. I mean, if you look at all dad's trades, and even the people that see it, you can see I'm buying the lows, I'm getting out at short-term highs, and I'm distributing my positions at these key points. Sometimes I do phenomenal and I get really, really close to the actual highs. But truth be told, you're not going to get that as a steady diet. So the way you manage that expectation and overcome the realities of you not being precise in the beginning or throughout your career, you're not going to be perfect. I'm pursuing perfect. It's always been a target that I know is going to evade me, but guess what that does? It keeps me chasing it and keeps me young and keeps me virile and like I'm hungry. I'm going to constantly seek that. And you're not going the wrong direction. You're always going for improvements because as soon as the day you come into trading and say, I have everything figured out, I'm never going to try to improve on myself. You're going to start getting lazy. You're going to start doing stupid shit, break rules, and then you're going to try to entertain yourself with doing dumb stuff that hasn't been taught to you. Thinking, well, let me try something, test, and you're going to lose money. And then it becomes a toxic, impairment that now you've done something and then you feel guilty about having done something that you weren't trained to do. And so many students, so many other traders that don't even use my stuff, they waste time doing that. And they become a waste as a trader because they've done stupid shit. So this is what we're doing to trade Asia. All of these elements are repeating factors that you as a student, if you want to be trading this time of day, this is what it looks like. This is the protocol. This is the guidance, Kimmel. This is everything that you need to do. And by doing this markup every single day, you will understand what you're having questions that arise in your mind right now. But what about this and what about that? All of those questions are going to predominantly be answered because you have exposed yourself to annotating the chart, doing this every single day, whether it be Asia, or whether it be the New York session like my son Caleb's getting himself prepared to be only focusing on, or if it's the afternoon session, okay? Or if it's London, and you'll see me do the same thing at London. Just as a tip I tip my hand to you. The delineation here, that would simply be at 2 o'clock. And guess what? It's going to do what I'm describing here. So all you're doing is you're watching what price is doing. The only difference is where we have the new day opening gap here. See, I love sharing. Instead of the new day opening gap, what we're going to be looking at is the 30 minutes after 12 o'clock to 12:30 New York local time, because that is your opening range for London. You're not surprised if you went through the mentorship on the videos on the YouTube channel. But for the people that just got here, they're like, oh, he's dropping the sauce, man. Oh, man, this is so good. ICT Jim's going to put that in a clip, I'm sure. But anyway, this day, obviously, moves back up in, consolidates. This is what I love. I teach this in the mentorship stuff too. It's everybody's like, yeah, it's it's creating a bull flag. You see how it runs up quick, consolidates, and they want to see another leg of that repeated up.
Mm-hmm.
That's fake. And I teach how to determine when those fake ones are in the mentorship on this YouTube channel. But it breaks down, it responds back to what level? Where old initial buy side liquidity was here. Now, the pundits will say, "Oh, he's doing is he's talking about support and resistance because see how it was resistance here. Just draw your line through here and it's just draw it up here." I know it's bullshit because there's so many instances where you can see where price has turned as a short-term high or as a short-term low, and you can have a line drawn there, and the market just runs through it and says, "See ya."
Mm-hmm.
Like it doesn't respect it. So why this creates an important turn here is because of what I outlined over here. It's initial reference points that the algorithm is going to refer to. When you start looking at support resistance, students that are listening, I don't want my son screwed up with that bullshit thinking because he doesn't understand the retail element of retail support resistance. But for the folks that are listening, have been trading for a while, you'll be better at selecting classic support resistance as it's kind of like promoted in books and courses and other people out there, or people that will watch me and say he's complicating everything. All you need is support resistance. I'm challenging someone else to every day go out on a live stream, okay, and tell us the only support or resistance levels that are going to work. So go fuck yourself, okay? Because that's the litmus test for anybody who wants to make a video or a live stream or leave comments and other people's bullshit. Okay, do a live stream. I'm doing this Monday through Friday now. Okay, I have an open schedule. I cleared my book. I'm going to be doing this every fucking day. So you that have that perspective that you think it's just support and resistance, okay, and I'm just doing that. Okay, now you have the task of being out on a live stream and doing the correct, only ones that work, support or resistance, okay? And you got to call the market around that because that's what I'm doing. You don't believe me? Look at yesterday. It's a fucking phenomenal reversal, wasn't it? It's lucky. It's all lucky. So anyway, we sweep back down below the new day opening gap after touching the initial buy side liquidity reference point, and then drops lower, goes back into that volume imbalance there. And then we cross back below new day opening gap. So what's below the new day opening gap that formed last night at 6 o'clock? We have the new week opening gap high. You see that? Mm-hmm. So that's the next level below us in terms of new week opening gap or new day opening gap. So now we know we can potentially draw down into that. Look at this low here. We're digging into the new week opening gap that was formed this Sunday that just passed, okay? We trade up. We're gyrating around the old level that was formed at 6 o'clock or post 6 o'clock where we had the initial sell side liquidity. See how it's referring back to that? It's gyrating around that, okay? So now everybody's grinning. They're like, man, this is amazing. This is amazing, man. I can't believe he's teaching this for free. I can't either. I don't know what the fuck I'm thinking. But anyway, we had this consolidation, and then we rally back up, and we're back into the new day opening gap, and then we trade right back up into a reference point for that old liquidity that was outside the initial buy side. You see that? Yes, sir. So we have a previous day high. We return back to it here. Boom, bump. Gyrate around the initial buy side liquidity. And now you can see right away, why does ICT use a notepad? Why am I referencing something I have scratched on my Samsung Galaxy Note, which is so much better than Apple? Apple sucks. Fuck Apple, the rotten Apple. We don't eat apples, okay? If you want to use a real phone, you're going to use a Samsung, okay? Samsung is the shit, and I have no affiliation with them. I rep Samsung.
No ad.
Yeah, Apple's burned me so many times. I would never use another Apple product. I don't give a shit. They made me a deal. I would never do it. And I'm not asking for a Samsung deal, by the way. I just want my opinions to be appreciated because it's real. But anyway, same thing here. We have that run up. It looks like a bull flag. Retail is going to say, oh, it's going to run higher. No, it's not. What's it doing here at 12 o'clock in the morning? All this run goes down to a random midpoint consequent encroachment of the new week opening gap. But now what has it created? There's a range See, I'm already starting talking about the London session. I can't wait to get it out of the way because I don't want to be. I really don't want to wake up to do it. I'm going to be honest. I'm really glad that I can sleep through London now because I used to be up all the time trading and doing forex.
Mm-hmm.
But I know I promised I was going to do it, so therefore I'm in. But anyway, from 12 o'clock there, okay, so 12 to 12:30, right there. Okay, that is your opening range for London. Okay, so that's enough for you folks that are chomping at the bit for that information. That range, the highest high and the lowest low between those 2 price points. Okay, think of it like the opening range at 9:30 to 10 o'clock in the morning, which is what we're involved in now for the opening bell. You extend that forward in time to the right, and you'll see that the market will refer back to it. In addition to how it goes back into the new day opening gap that formed last night at 6 o'clock. See how look at the beauty of this. Bang! Drops back down. And it gyrates and works inside that range and then finally pops through, consolidating around the old initial buy side.
The same way it did before.
Yep. And then hits the old buy side, hits it, hammers it, and then we have this big pump up here. And now we're in 6 o'clock in the morning. It drops back down into new day opening gap, bumps the old high of previous day, hits it one more time. So many trades are going to be formed around previous day's highs. And that was the first thing Dad taught on Baby Pips back in 2010. I said the majority of your big, nice setups are going to form around old highs on old lows. That meaning that previous day's high and previous day's low. So you can see the elements of that unfolding here. What is this level down here? See, I'm testing it.
That's the initial sell side liquidity.
Yes, very good. So it trades up, hits that, and drops. Now think about it, okay? I'm telling you how to find the real support and resistance. Is it not respecting these levels? It's perfect. Yeah, it's perfect, right? So it's going right to them, hammering. What time of day is that forming?
7:58, 2 minutes before 8.
So we have the 8 o'clock hour. We're watching to see what this price going to do. Well, we have low, relative equal lows, and it's here. So what would you expect to see? It drop. What happens if you miss this move, son? What happens if you see it start to drop? And you miss this reaction here. What are you going to do? You're going to wait. What are you waiting for? Waiting for a fair value gap or a volume imbalance? There's a volume imbalance. Mm-hmm. And then we have the open. It trades up, goes right into that. There's your short. And what's it going to aim for? The relative equal lows that we were just looking at before I did this. Over here. So you have an entry here that targets these relative equal lows and these relative equal lows. Looking further to the left, we have this down here. Isn't that a relative equal low?
Yes, sir.
And where's the market go?
Well past it.
Where does it trade down to?
On the new week opening gap. Low.
Right. And then what does it do after that? Reaction. See, folks, listen, okay? This is why I laugh at all of these asshats, okay, that sit back and say, I reinvented something. I didn't reinvent shit. I didn't rename anything. I'm teaching you stuff that they can't find the source of to be able to say, here's the $5 million payout to me, ICT, because I'm exposing you as somebody that's renamed shit. This is the biggest long-running conspiracy theory there has been since I've come out and started teaching. None of this information is anywhere else except for initially out of my mouth. This stuff is new. This is the new breed of technology in terms of reading price action. And it's been in my hot little hands for the last 3 decades. And I often wonder why on earth would I absolutely be sharing this stuff? Sorry. It is what it is. But the reaction you get here and it runs up, if it's going to have this much of a reaction off that low of the new week opening gap, what is reasonable for it to see it reach for? If you're inside of the new week opening gap and it's shown the willingness to want to react this way, it's the midpoint. And then if we're going to see this level breached and pierced on the upside, it does it here. It's dropping back down. Why would it want to drop back down? It's going to a discount, like a slingshot. Right, like I was saying, a slingshot. But it's reaching down into an inefficiency because there's no short-term lows in here except for that tiny one right there, which to me doesn't have all that much of importance. But my eye jumps right to that. You see that?
Yes, sir.
So if you're seeing, look at the perfection there. I mean, look at that.
You couldn't have been more precise.
It hits it and then and runs. Same thing over here. Fair value gap, drops into it there after taking a short-term low out, rally. It goes back to this level. Now from here, I want to see it trade above this high here. It does, and then we can react off of the consequent approach at midpoint. And then it runs back up to, what is this level again?
That is the initial sell side liquidity.
Right. And for the folks that missed what that was or joined the stream late, it was derived from there. So we're not Sam Seiden's online academy. We're not teaching supply and demand. We're not doing classic support and resistance, renaming it and calling it something complicated. We're taking you with a view, a perspective that is technical science. I'm teaching you how to refer back to the same levels at the specific times that the algorithm will do. There's lots of them that I can't teach, but these are the ones that I can teach you where it's perfect really that people say you're just teaching supply and demand or support and resistance, because I'm hiding in plain sight. If the lazy people come and see that's what it is, okay, replicate it. If that's all it is, go do it too. They won't. They can't do it. That's why they teach and show examples in market replay. But we are in the opening range. Now, this is the part where we talk a little bit about something that you need to be worried about if you're going to be trading in that 9 to 5 hour, okay? So if you get your trade done beforehand, then don't worry about it. You're taking one good setup. Once you get it, you stop. You're not in here trying to impress dad. You're going to impress me by doing your one trade setup, and it pans out based on what you're trying to do, and you're done. I'm going to be more impressed with your ability to not trade more than you should than taking a lot of trades. Right. I want you to have the ability to sit still, because that is what messes everybody up. Everybody does the wrong thing by trying to be more active than they should. All right, so let's get this off here. And now, if you look in the lower right-hand corner there, it says electronic trading hours here. That is 24 hours in the day. It's as long as it's trading, you're going to see every candlestick. When I click on this, it's going to give you a regular trading hour option, and it's showing that we're showing electronic trading. Predominantly, I'm going to have electronic trading hours shown, okay? But if you're going to be trading in the 9 o'clock hour, if your trade hasn't formed yet, or if you missed something and you just want to be engaging post 9 o'clock at the opening bell, you're going to set your chart to regular trading hours and watch what it does. Looks different, doesn't it?
Very much.
So what's actually occurring is you're seeing the difference between yesterday's closing price, the regular session hours, and it's using 415. It's very confusing, because electronic trading continues still, even though when you watch the TV at 4 o'clock, they ring the bell, ding, 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 and they clap their hands like they fucking did something special. They didn't do anything. Then for 15 minutes, it settles. And at 4:15, there's technically the day session is done. But electronically, it's trading until 5 o'clock. And then it stops, and then it opens at 6 o'clock. So you can see how this quickly becomes very confusing for someone that's never looked at it and studied it. But for the sake of viewing what it is that's important about this perspective of regular trading hours, we have already arrived at what it has done here as a run up and hit it and then move lower, because this is your initial sell side that was set at the opening at 6 o'clock or shortly after. So when the market runs up in here, hits this level, it's actually hitting also the opening range. The opening range is 9 o'clock to 9:30. And it's down there. Okay, so 9:30 is the opening bell. All of this is the opening range. There is no 15-minute opening range. Okay, opening range, algorithmically, it's 30 minutes. It's 9:30 to 10 o'clock. In that range, it's doing the same thing that I said when we were looking at the 6 o'clock new day opening gap. It's establishing initial buy side and sell side. That's what it's doing in that 30 minutes. Sometimes the market will just break and never have any kind of opening range impact. It just opens where it opens and it starts running. In this case here, we can see that it's opening and trading back up into not a full return back to the previous close. See, it didn't go up there. It just went right to where I gave you the initial sell side liquidity, how to frame it. Goes right to that, does a majority of the closure of the opening range, this, where we opened from where we closed. That difference is a gap. So in other words, when they're watching price until it opens up, this is what you're looking at, where we stop trading. Okay, we stopped trading the previous day at 4:15, and then regular trading hours. This is what we're highlighting here. Regular trading hours. The next opening tick, the very first print or very first trade at 9:30, it opens up down there. This is the green candle. What is it showing? The opening is the low. Okay, so as soon as you have that, you're going to highlight that entire range and then watch price. You're not pushing buttons. You're watching price to see how it behaves. Normally, not always, normally, when you have such a large gap like that, what will happen is the market will create sometimes it'll open, trade a little bit lower, and then start working higher, drop back down, either take the low it's formed or just like it did here very subtly, and then rally. Why did it run initially straight from the opening? Because we had already taken out this low. See that? And then we worked into that range all the way up to the initial sell side liquidity, not the entire gap closure. That's a huge paradigm shift for people that have asked all the time. How do you know when it's not going to be a full closure on the gap? Well, you're going to implement what I just did here. And all those factors are going to be weighing on whether or not the gap completely closes or not. I like this. Generally, even if the market's going to be bearish and continue going lower after a big gap lower like this, generally you have about a 70% chance. And I say this now, everybody's going to think that means 100%, but it's not. 70% chance that it's going to go back to mid gap. So there's always a trade available when you have a big gap down like that. That right there, trading back into the midpoint, that is good. And look what it did. It trades, and for people that heard that for the first time, they're thinking, well, he's saying that because it happened. But I have traders that have been with me for 12 years now, and they've heard me teach this before. In mentorship, I've taught this. I can't remember if it was 2022's mentorship or if it's just a regular video I did. But I talked about, no, it was live streaming is what I was doing. I was doing live streams, and I talked about how it's easy for the market to get mid gap. So mid gap is really, really, really strong probability. If you gap lower, just find the midpoint, which is what that is. Okay, and you can see it does that, and then what does it do? It goes right back down and just bumps the low. And then you get that run all the way up to the initial sell side liquidity, which could have very easily retouched the close yesterday at 4:15 or half of that wick. Okay, so I want to talk a little bit about the chart on the electronic trading. So doesn't the chart look totally different now?
Mm-hmm.
Very confusing, isn't it?
Very.
So you have to have reference points. And what that does on my phone, usually, I'll scribble, the key levels. Like I'll have the levels in numeric format here. And I'll write down new week opening H. And then, the date it was on. And that's what's scribbled on my pad. Everybody wants to see my notepad that's next to my charts as I'm doing it. Like it's going to give them something special. And all it is I don't want it on my chart. I just want to have the reference points. And as I'm watching price, like right now, it's trading at 18,482 and a half. Okay, I'm looking at my notes, and my notes say I have new week opening gap high at 18,513 and a quarter. So I'm in close proximity to that. So it could come back and gyrate back up into there. It can do so even further because we have what in play? What's this?
The initial sell side liquidity.
No. Visually, what is this? What are they? Relative equal highs.
Yeah.
Yes?
Yes.
This high and this high are relatively equal. And then you have this one over here. Even though we bumped it a little bit, that right there is still too clean for me. It's too clean. So I want to sit back and watch and see, do they have any interest in trying to press back above that? I think that if they're really going to dump it today, going into the weekend, because there's a whole lot of things going on in the Middle East that everybody's afraid that it's going to pop off. And those types of events that are looming, that is always going to be used as a stimulant to upset, engineer, or impact sentiment or how people see trading. If it's risk on, which in my opinion right now it's risk off. Risk off means that there is no one willing to really try to go in and think that we're at a long-term buying opportunity because there's so much uncertainty. That's kind of like what I'm getting at. There's too many things that can go wrong, and that scary type of looming event on the horizon could cause stocks to tumble because the street money thinks that that's what causes the market to drop, and that's not what it is. But the algorithm and the people that have control over it, they will manipulate price so that way the sentiment is shifted based on the assumptions that WAR events would possibly, be a catalyst for why the market crashes or has um, unfavorable price action. Okay, so there's a lot of things that you have to weigh out over time, in your development. But initially, knowing what to look for and then studying these fluctuations around it and studying how the market behaves around these elements of reference in time and price. What are we talking about? And when we say time, obviously, there's specific times that I'm teaching you to look at. But what's the price aspect? At that time, are we referencing an inefficiency or are we referencing liquidity? You see how that's very simple, isn't it? But it sounds ambiguous or it sounds lofty and complicated when I just say the market works on time and price. And they think, okay, well, what time? Well, it's the elements that I've taught in mentorship videos and lectures and the things I'm teaching you this week. But when it comes to the price, what's the price? The price is either an inefficiency or it's liquidity. It's something above an old high or below an old low, or relative equal highs or relative equal lows. So they're not hiding from you. They're not hidden in the chart. They're not going to morph into something different. Like when I just toggled from electronic trading to regular trading hours, it looked like a different chart. And then back from regular trading hours to electronic trading hours, the chart looks completely different. It looks like we're looking at a totally different market. Yes or no?
Yes.
So having the right reference points is like much like having a navigation system in your car. If I write down directions and say, turn right here, turn right there, go about this, you still might get a little lost. But if you have the navigation system on, where it tells you, oh yeah, there's a rest spot or a gas station in 2 miles. Okay, well that's the same thing we're doing here. These levels are annotated on the chart for you to say, okay, there's a reason or a destination that could be had or met. If it goes up, it can go to those levels. But what you're going to be doing is you're going to be looking to see when there's time for these markets to start gyrating in a direction. And then the price is providing you an opportunity that you have identified. That's something that you see repeating all the time. I'm forcing this part on you. I want you trading the fair value gaps. That is going to kill two birds with one stone. Number one, it's easy for you to see visually. They don't hide. They're very obvious in the chart. And most of the viewers that are watching your development, they understand, even if they can't pick the right fair value gap because that's what they're concerned about, they'll learn by default which ones that you're gravitating to that has my support in saying that, yes, that's the right way of doing it. And they, by default, will have a baseline understanding. And even if they don't have the fair value gap as their model or entry, they'll at least get a better foundation on how the markets are booking, what time they should start moving, what it should look like. And even if they're studying the fair value gap, most of them, if they're going to be honest, they're going to find that they'll see another PD array that I've taught, and their eye just by default will go to that. And they may use your fair value gap initially as the catalyst, the trust that's going to move. But then they may do something entirely different, trade an order block or trade a breaker or something like that. And then that will be the catalyst for them to actually get in a trade. They won't be getting in when you would be getting in because they're going to wait to see if you fail. And they want to be able to say, I'm glad I didn't do that because he failed. That's his own son. He failed. But they'll take a trade if it moves a little bit beyond that. And then they see the thing that they like to trade and then they'll trade it. But they're going to have more anxiety versus when you get a trade on, you're going to be in open profit. They're going to be in a new entry managing potential short-term drawdown that they have no idea how far it's going to move against them. But they're going to refer to where your stop loss would be and how you would manage that trade, and they're going to have a larger stop loss. And that's going to cause anxiety and scary feelings, and it's going to be a terrible toxic learning experience because they're not going to follow the rules, which is what I'm pressing on you not to do. Don't break the rules and don't try to reinvent things. If you didn't do it when you were supposed to do it or how you're supposed to do it, do nothing and just watch it and observe it. Okay. So yesterday I talked about how when the market has, or was it yesterday? No, it wasn't yesterday. It was the day before, where there was no news in the morning. Yesterday we had employment data, and then we had a bond auction at 1 o'clock again. But prior to that, I think it was Wednesday, I said there was no medium or low impact news driver for the morning session. And I said when you have that, the market can gyrate and move around from 8:30, and let's go back to 8:30. There's 8:37 right here. I'm sorry, 8:36. The market trades down to new week opening gap low. Okay, and then we rally up, come back down, fair value gap, rallies back to midpoint, consequent encouragement, and then you want to watch and see does it have the ability to trade above it? It does. Comes back down, touches the consequent encouragement, and then trades back up to minimum new week opening gap high, but trades to the initial sell side liquidity reference point that the new day opening gap protocol teaches us to look for. So it trades to it here, and then we follow it a bit. All of this price action right now, as we're seeing, is exactly what I outlined when we have no medium or high impact news drivers in the morning session. The market can be aimless, it can be choppy, it can be not as clear. Now, there can be big, huge runs on these types of days because of external stimuli, something happening, okay? A la the things in the Middle East, okay? Mm-hmm. Or domestically here in the States because of who's running for election and whatnot. All of these factors are weighing heavily for me as an analyst looking at the market saying, okay, I don't want to be holding anything overnight. I don't want to be trading very large. I don't want to be taking more trades than I should. And that's a beautiful perspective to hold learning how to do it. Because if you start that way, then you have a better chance of not having all the bad stuff getting introduced to your perspective and or your actions as a developing trader. Because it's easy to pick up bad habits. Really, really easy to do that. And looking at what the market has done thus far, we have really nice reaction off of the new week opening gap. We've explored price up here prior to the session starting. It's Friday, okay? So what can we do? We can look at the weekly range because we have moved one-sided. We've moved so far one-sided that it's reasonable to see Friday have a retracement back into the range that was formed from Sunday's opening all throughout the week of trading. How much of a retracement can we pull back in? We can trade back into that range 20 to 30%. It doesn't mean that that's trying to predict the closing price on Friday. I'm not trying to do that. I have stuff that does that, but I'm not trying to do that for the sake of the TGIF scenario. Thank God it's Friday is simply a way for me to kind of like press on the students to think, okay, thank God it's Friday. It's a big week directionally one-sided, and we've had that this week. We've had the market just go straight on up, and we had a lot of movement to the upside, which means that the market is more inclined to trade back in that range to a degree of as much as 30%. There are rules that can see as much as a 40% retracement, but I have not found a way to teach it in a manner that wouldn't be complicated. So as I've mentioned it to private mentorship students, there are things that I have that I can't teach everything, obviously. I mean, it's enough to know that 20 to 30% is an easy ballpark figure. And you can trust sometimes taking shorts on a Friday that could trade as low as 30% of whatever the highest high and the lowest low for the week is. 30% minus the high of the week. That's where you can anticipate the market potentially trading to. And sometimes it's a straight shot. Like it'll jump right there and go real nice. And then once it gets there, then it peters out and goes sideways and then maybe bounce up a little bit, but then it's nothing else for the rest of the Friday. The market just dies out. Other times it just meanders around a little while, breaks down, meanders a little while, and then breaks down. And I think that's possibly what we'll see today because there's nothing to speak of on the economic calendar except for it's the end of the week and nobody wants to hold risk over the weekend. And they can do a nice reset by having the market come off of the highs 30%, and it wouldn't unravel anything. Even if it's long-term bullish still, it's an election year. These things can be still supportive, even though nobody that wants to be long or is long wants to see 30% of the weekly range give up. Like they don't like to see that profit be reduced or open profit without having taken any from it. All right, so let's take a quick look at ES real quick as a comparison. We haven't done that all week. All right, so give me a second here. All right, so the S&P looks even worse than NASDAQ. Looks really bad. I wouldn't trust anything in here. It still looks a little too clean on the up here. I would disrupt that before we did anything lower. That's my personal view on it. If it dropped, it would be comfortable for me to say it's okay. I don't need to be a part of that move. I wouldn't take anything in ES. Let's look at the Dow. Dow is YMU2024. Same thing here, too clean. It would be reasonable for it to see it spike up into that. I don't trade the Dow. The Dow to me is the dirty 30, and if there's a prostitute in these indices, it's definitely the Dow, and I ain't trying to get an STD. So this is one I don't touch. I look for it to kind of confirm market breadth and continuity in a price run. If there's a divergence between it, I will have it on the radar as a contributing factor for determining whether or not I want to take a partial on the trade. If I start seeing the Dow go against what the NASDAQ and the S&P are doing, I will be cautious, but I won't probably trade with a complete closure of the trade because there's a divergence in the Dow because it's only 30 stocks that make up the index. But if I do see a divergence between the NASDAQ and I'm long and the NASDAQ has a higher high and S&P does not have a higher high, the chances are I'm probably going to take a partial off the trade because it's indicating a weakening momentum or in agreement with the and Scout jumping in. Don't even look at it because she'll just keep doing more of it. The any divergence that I see in the Dow, I take it with a grain of salt. But if I see a divergence and there's an inability of the NASDAQ and the S&P to make the same highs, to me that's a more valid S&P divergence. In other words, it's indicating there's potentially much more weakness that may not be visible to the other traders that are trading it because they're not comparing and contrasting the difference between the three averages. So I think it's reasonable to see the Dow go up and disrupt this smooth area here because what's happened down here? This is all that jaggedness, right? So this down here is smooth. So it's to me, it just makes sense for them to basically get all of this smoothness disrupted. Back to ES. Same thing here. We have these relative equal highs. I would expect them to disrupt that as well. Even though we had a higher high here, we can go back to this one. Now you can see the conditions are still being there. We have smooth relative equal highs here. If that was what you're framing on, that's great. But if I'm going to refer back to this one, it's in comparison to that, and it still meets the criteria.